or diversification to other forms of trading. Basically, the reasons we highlighted are the lower margin, because that will enable you to test all your capabilities, that is the skills regarding the technical analysis, fundamental analysis, as well as your psychological ability, then your time. All those things can be tested with a lower margin, and so the learning curve can be better rather than putting more money and and also markets which probably are more volatile. So this is a lower margin, lower volatility product, and so this could suit the personality of some of those who prefer a little more calmer and steady market, right? Because there are different classes of investors. Some may prefer to trade in crude, some may prefer to trade in Nifty, some may prefer even lower volatility. So those who opt for such lower volatility can look at currency trading. One. Second thing is that we also said that it is a very well regulated market. Third, it's a major macroeconomic variable of the country, and hence it will be completely have a RBI will have a very tight monitoring of the movement there. So we will not have huge losses in case if things go against our positions. So these things enable us to consider that why we should look at the trading in currency. And also we said that the other aspects that are very important is not only the regulation but also the liquidity in the market. And liquidity is measured in terms of bid ask, and bid ask spread is very low as far as dollar rupee is concerned. It's only quarter paise. That means the contract of $1,000 means only 2.5 rupees for each pip movement. And also we have got a very good volume, in the sense that every day the volume traded in one exchange itself is more than 15,000 crores in dollar rupee in 1 month contract itself. So similarly you got other exchange also, BSE. So total put together there will be 30-40,000 crores of futures alone traded, leave alone the options. So there are two segments there. There is a currency futures, then you got a currency option, then you also got a weekly futures. Unlike Nifty, you got a weekly futures also here. So in all ways, it's a very important alternative asset class for trading. Now we know about the Nifty, the stocks. Then we are also a little bit familiar with certain commodities like gold for investment and trading. We are not very familiar with dollar rupee because most of the dollar rupee exposures or other currency exposures are more confined to corporates. So slowly, if you start looking at it, probably you'll also get familiar, because if you are a technical analysis trader, then it doesn't matter whether it is gold, copper, zinc, or Nifty or dollar rupee. You just need the right tools to analyze the trend and take positions. That's all. And also this is a 9 to 5 market, and you got a 5-day week. So very clear delineation of all the important aspects here. So this one, and also a very calm market, literally a calm market compared to Nifty or compared to commodity markets or equity markets. Now there are two factors. Now how do you look towards the currency trading aspect? What are the parameters that we should consider, and how should we take positions? Now, like any other market, you got a fundamental factor, then you got a technical analysis, right? So you got a fundamental factors which affect market, then you got a technical factors also which impact the market. So in the case of fundamental factors, how do you learn about the fundamental market? The way we learn about the equity market, that's how we learn about the dollar rupee also. So we have to read things which are more concerned with the currency markets. So it could be the crude oil, which has an impact on the dollar rupee movement. Then you've got a trade deficit, which is just to be looked at it. Then you've got dollar index, that is dollar rally against other currencies, that needs to be looked at. So once you get familiar with the major fundamental factors which are affecting, so you will clearly know which direction the dollar rupee is heading towards and what we should do. Okay. So I will just list out some certain important characteristics of the dollar rupee portion alone right now. See, dollar rupee fundamental factors. I will also touch the technical factors. Dollar rupee fundamental factors is affected with what happens with USD index, that is the up or down movement. This will also impact dollar rupee. That is, if the dollar continues to go up against other currencies, then dollar also will rally against rupee. Now, second factor is Indian imports and exports. So which is the imports and exports, which will determine what is our trade deficit. That is, basically, if our imports is more than exports, that means the demand is more, right? So if our imports is more than exports, then the demand for dollar is more. But whether there are any other offsetting things like capital flows, FII flows, then FDI inflows. So if this could match the deficit, then probably we can come to some sort of a neutral position there. But the timing could be different, right? So this one there could be more deficit. FII flows could also be deficit. FDI flows could be positive. So later on in the next coming months we have excuse me. So in coming months probably we will see more of FDI and FPI. At that time the trade deficit could be more. So the timing difference is what will dictate the movement also. So these are major factors. Of course, we have got the interest rates. So all these things will have an impact on the dollar rupee spot movement. So when we talk about spot movement, so this is like the same in Nifty futures. You are familiar, right? So you got a spot, you got a futures there. So generally the futures rate will be more than the spot, and the difference is the interest rate differential, right? So the interest rate differential with respect to the dividend. So suppose if the interest rate right now is say 5% per annum, repo rate is 5% per annum. So spot and futures, the futures will have some difference from the spot. Maybe it could be 20 paise, 30 paise or 40 paise more, 40 rupees more than the spot. So the futures will tend to be generally more than the spot. So this is the normal characteristic of the market, right? In the dollar rupee market, in the Nifty market. Similarly, in the case of a dollar rupee, there is a spot market, then there is a futures market. So the spot market is not, we are not concerned about spot because only corporates are concerned, because there is a, I told you, in the case of exchange, we have got a cash settlement. We don't have a physical settlement in terms of the dollar rupee. That means you go for dollar rupee, then at the end of the tenor of this particular contract, whatever difference that you have will be credited, or if you have to pay, it will be debited to your account. Now, in the case of Nifty futures also it is like that, right? So it is not something which is delivered into a demat account. You have a cash settlement. So something very, very similar to Nifty futures is the way the dollar rupee settlement also takes place. So there also, like in Nifty thing, there is a spot, there is a futures. So futures also there, the differential will be the difference between the Indian interest rate and the USD interest rate, because we are speaking about USD INR. It's a pair. So the pairs, whatever the interest rate differential that exists between the dollar and the rupee will come in terms of the forward premium. So the forward premium generally is around approximately right now we have got a 20 paise. So the spot, then you have got a futures. So 1 month futures. So normally the 1 month futures is the most actively traded. That is, right now we have got an expiry on 27 July. 27 July. The next one, I don't know what it is, maybe it's 28th August is the last date of futures. Okay, so till 27th July expiry, 27th July futures will be heavily traded. Then after that, it will become the next one like Nifty futures. So the 28th August will be the heavily traded. Though there are weekly futures, generally the volume is more towards the monthly futures. So you got a 27th July, then after that you will have a 28th July expiry contract which will be heavily traded. Now if you look at what is the spot, say let us say spot is 79.20. Okay, then assuming this is 79.20 and we are at on 27th July, let us say on 27th July spot is on 79.20. Then the 28th August price will be something like 79.45. There will be a 25 paise difference. That means those who sell get a premium, those who buy will always lose the premium. So that means the volatility has to be first of all more than the premium amount that you pay, because if you have end of the month volatility which is less than the premium, then those who buy will definitely lose and those who sell will definitely make money. So what we need is a volatility factor which is more than this. Okay, now generally speaking, over a period of time, that is over a period of 3 years and 5 years and all, normally the dollar rupee, the forward premium to some extent is a guidance of what the rate will be in future. But in the shorter term it will not be. Suppose if I say 1 month later on the premium is 79.45, then if you expect that 1 month later on the rate will be 79.45, no, that will not happen. it just tells you that the rupee has to depreciate by approximately 25 paise in order to make this interest rate arbitrage neutral. Otherwise, you will be having in one currency some interest rate liability or asset, another currency you invest, then you make the differential. So what is this saying is, basically it has to be something around the 79.45, that is 25 paisa premium from the previous month, in order to ensure that there is no arbitrage. That is what it says. Whether the spot rate will be 79.45, more than 79.45 or less than 79.45 will be dictated by the demand and supply which exists over that particular tenor itself. See, last month rupee was around say 78. This month now it's already 79, 70, 80 levels. So the volatility cannot be equated to this premium, but normally the volatility, even if it is much higher, over a longer period of time things will settle along the forward curve. That is, when you speak about 3 years later, and 3 years forward premium, assuming it is around 3 rupees or so, end of 3 years maybe the rupee could be 3 rupees or 4 rupees, or it could be 2 rupees, or something very closer to that. Okay. And so there will always be, over a period of time, Indian rupee generally will continue to depreciate over a period of time, because we normally run a higher inflation compared to other countries. So normally our currency has to generally depreciate over a period of time. But having said that, this is like a Nifty futures. Now suppose if you ask Nifty, over a period of time, any market expert will tell you that over a period of 3 years and 5 years you will make money. So what does it mean? After 3 years or 5 years, the Nifty at the end of third year or fifth year will be more than the present Nifty level, and probably it could give you a return of something like 10% per annum, which means that if Nifty is at 16,000 right now, then it should give 30%, if it is doing 10%, 10%, 10% every year. So it should be 16,000 plus another 4,800 at the end of 3 years. It should be something like a 20,800 or so, right? So that is how normally you say when it's 10% per annum growth, then you expect the Nifty to be something like that. But in the shorter period of time, things can go up, can come down, and eventually it will give you a return which could be around 10% or 12% per annum over a period of time. So that is the same thing in terms of the what the futures reflects here. Over a period of time, the rupee will depreciate to the extent of 3 to 4%, 3% or 4%, and that is how the forward premium is also there. But within a shorter period of time, things can be very different. That is where the technical analysis comes. So from the fundamental point of view, generally everyone knows that the spot dollar rupee will always the dollar will again on a spot basis it will continue to go up. So why I am saying this, if you look at the chart over a period of time, in 2014 rupee was 60. 2014 May it was 60. In 2019 also it was something like 67, 68 levels. It was approximately there. Okay. Now in 2022, now it is now closer to 79, 50 or so. So that means if you see over a period of 2014, rupee spot has depreciated from 60 to 79.50, right? So it's approximately 30%, but 30% over a period of 8 years. So which means it has depreciated to the extent of 3.5 to 4%, which is almost the forward levels. It is almost the forward level over a period of time. Now, if you look at from 2019 to 22, it has depreciated something like 10 rupees, means around 12%, 13%. It's again over a period of 4% also. So over a period of 3 years and 5 years, normally the spot goes to the extent what the forward curve says. But within that, there will always be no continuous amount of volatility or vibration around that. So if you're suppose if you say that I'm going to hold dollar, okay, and what return I will get. Suppose physically you are holding dollar, and what rate it will give? It will give you some 3.5 to 4%. It will give you some 3.5 to 4% return if you are just holding the dollar. If you are holding the dollar plus some interest rate you will get. Okay, so all those things will point to something 5-6% or so. So if your Indian interest rate is going to be more than that, there's no point in putting this here, right? So so here what's happening is that if you roughly do the calculation, this is what it is. But we are a trader, so the fundamental aspect is to be looked at, saying that okay, over a period of time spot will go up, spot will go up, but I'm going to be in the forward, because you cannot buy the spot, because if you're buying the spot you need to have physical currency, which is not allowed beyond a certain level. It is not allowed. So what you're doing is that you're going to allow you're going to buy a futures, and in the futures you are paying the premium. So that means you're paying a premium. Whether this is going to be equal to the 3.5-4%, then in that case you will not make any return. You will not make any return, right? So that is where the technical analysis comes into play. Now when I talk about the same thing, because if you are familiar with Nifty futures, Nifty, I will try to draw a parallel. Nifty spot versus Nifty futures. Now say Nifty futures, the differential futures and the spot, let me say it's 5%. That is the futures, if you keep on rolling it over, okay, from month to month, let us say you are paying something like a 5% per annum cost. If Nifty is going to have a return which is only 5% in the spot, if Nifty cash spot is going to have only a return of 5% over a period of time, absolutely you will have a zero return by doing the futures, right? So you will have nothing. You'll have nothing. So if the Nifty the futures is going to give you a 5% thing, and if the spot is going to give you something like a 10% return, then the Nifty futures will give you a return of 5% per annum. Nifty futures will give you a return of 5% per annum, because you're paying the premium. So that also has to be factored, right? So that also has to be factored. So you will get something like a, but within that, if you see the volatility has been, for example, 2020 March, it was now let's say 2020, before the pandemic, it was 12,000, right? Now, so after the pandemic it crashed to 7,500. So we will take this completely as abnormal. So 2022, okay, approximately 12 to 15 months have gone, and we are at 16,000, right? So it's a 4,000, 2 years. So 4,000 in this means around 33, still 35%, right? 34 or 35%. So approximately, if you see, the return will be for a 15, now it's a 27 months, right? So 34, so 12 divided by 27 into 34%. So this is giving 15% per annum. So right now, over the period of this time, it is giving a 15% per annum, right? So this is if it is giving 15% per annum, means futures will give you minus 5%, so you will get 10% per annum. So this is a normal trend, but within that, what happened? Nifty went from 12,000, went down to 7,500, then it rallied up to 18,600. So all erratic things took place. But the stability has come closer to the 15% right now. And over a period of time, we said that no, in the longer period of time of 3 years or so, generally speaking, it should give you something like a 12% return. 12% return, which is which should be 3 years back what was the rate, and today 3 years after that it should be into 1.36. That's the normal rate, and after that there can be something more to that added to that you can keep. But if it is going to be very abnormal beyond that, then in that case it is going to come to an equilibrium position. It's going to come to an equilibrium position, and from there can be again some rallies that can take place. So we need to be quite clear about what is the return over a longer period of time, and within that volatility that could take place. So if you are from the fundamental point of view, you analyzed, but now from there you are now coming down to a micro position. So the macro position, once you understand that the spot in dollar rupee will continue to move over a period of time, but to what extent it moves, whether it moves along the forward curve. If it moves along the forward curve, every month I only buy, then in that case I may not make money. But if I sell every month consistently, there could be periods like this where the rupee has now fallen something from 74, 75 levels to 80 levels. Then in that case you will lose. You cannot wait patiently for a longer period of time. You will be frustrated. So there comes the importance of technical analysis, right? So there you have to look at the position trading, okay, then intraday trading. So now what we are talking is either you are going to be as a position trader, or whether you're going to be a technical trader. Now, fundamental aspects, yes, like how you read a balance sheet of a company, you need to look at the macroeconomic variables as far as the dollar rupee is concerned, and that you will come to know as you interact with journals, that is, as you read materials, okay, or as you listen to what the voices say, same voices say. So there you will know, then after some time you will pick up all those things and make a study, then you will know that at this point of time, because of certain macroeconomic variables, things are not favorable for the rupee, like FII selling taking place, crude oil going up, trade deficit going up, dollar is rallying against other currency, US interest rate is going up, and these are the combinations which will definitely have a negative impact on the rupee. And hence, no, at this time, at this point of time, it is better to consider the long position as far as dollar rupee is concerned. So you get a big headline message. Then after that, what you do is that you know now how do you look at the position in terms of where to buy, where to sell, and what to do, right? So let's look at that. Now, generally speaking, if you are a position trader, like no, like any other uh, asset trading, okay, for analysis, you generally normally take the first understanding is to take the moving average easily for understanding purpose, right? So it may have its own disadvantages, but any technical analysis will also have its advantages and disadvantages. Okay, so we will look at the simple thing for to understand. Now, if USD INR pair, now how do you whether you are long or short right now? USD INR pair, if it is going to trade above all important averages, let us say 5 day, 10 days, 20, 50, 100, 200 day. If it is going to trade above all these things, and within this is important, 20, 50, 100, 200. If this is going to trade above all these things, then in that case, you are long. That's all. You are long in the market, right? Now, trailing stop loss. Trailing stop loss. Okay, is that you are above all the averages, but suddenly it falls below 5 day moving, 5 day or 10 days. Then in that case, trailing stop loss. Below a 5 day average or a 10 day average, whichever you want to choose. Okay. Now, again you enter if it is going to be above 5 day and 10 day. The first change in thing is if it is going to be below 20 moving average, and there is going to be a huge difference between the 50, 100, 200 and 20. There's a huge difference between 20 and the next moving average is 50. Then if it starts falling below 20, okay, probably then you can short the market because it is generally a sideways, because if it is in between moving averages, it is considered to be a sideways market. But if there is a huge difference between 20 and 50, then in that case you can go short below the 20 moving average, take profit close to the 50-day moving average or 100-day moving average, right? That's all. So very simple formula for position trading as far as dollar rupee is concerned is this: if it is going to be above a 5-day, 10-day, 20, 50, 100, 200, all moving averages, you are long in the market. The trailing loss stop loss is 5 day. Now let me go straight away to the chart on a daily basis. So we are putting the spot now. So this is the dollar rupee movement. You can see, suppose if Nifty looks like this, then you will be very happy because you will be in the long side, right? So most of them wish to be on the long side of the market. So let's say it's happening this way. Now we will keep some averages to show. Now we will look at first the, it is definitely about 200 day, 100 day, 50 day. There is no necessity to look at that at all. So we will look at the other three moving averages, 20, 5 and 10. Okay. So moving averages, we will go in this is a trading view. So moving averages. So here we will, this will make it as 10. Getting this. So So this is 9. Okay, so we will make it as 5. Okay, so now if you see, we'll make it bigger, broader. So now clearly it is above the 5-day moving average, right? So we will be long in this market. Now it is above the 5-day close. That is, the close should be above the 5-day moving average. If the close is above the 5-day moving average, then in that case we are looking towards on the long side only. Now we will look at the 10-day moving average. Here, make it as 10, and look at some other color not to distinguish it. So we will look at maybe yellow. Okay, so this is 10-day moving average. So we see no, it's also above the 10-day moving average, so it has not fallen below the 10-day moving average. So we look at the 20-day then. This is 20-day moving average. Now change the color, maybe okay. So the lower level is the 20-day moving average. So we see whenever it is above the 20-day moving average itself on a close basis, we are on the long side. So the trading stop loss can come either at the 5-day or 10-day, whichever you feel it should be. And the trend change, probably for the time being, we can keep it as 20-day moving average, which can keep it as a 20-day moving average. So this is a simple way of looking at how to trade. So now we are straight away on the long side, okay, long side of the market. And last time the dip was up to the 10-day moving average. So we can keep 10-day moving average a fall below the 10-day moving average, which is coming closer to the 79.18 or 79.20-21 levels. So now you can say straight away confidently that we will go on the long side of the market, keeping 79.20 on a close basis as a stop loss, So a very straight simple thing. Sometimes you will have some sort of a clustered thing, so that some filters we can always put it later on. But what I'm saying is, generally speaking, you will have a very clear clarity on this. Now we can also look at the trend line. So the trend line that we can draw here is the last two important lines. Now, or okay, we can last two important pivot points. So this is the we are drawn keeping the last two important pivot points as the for trend line point as trend line points, and that also shows that clearly right now it's even higher. It's coming to 79.31 or 32. So 79.31 or 32 is the stop loss that shows. So that as long as we don't get much below 79.31, 32, I think we can be on the long side based on the trend line. That's all. So straight away simple. Right now going still on the long side. 79.30 as a stop loss based on the trend line concept. Finished. That's all. So it's a very simple thing. Similarly, you can also work on the same S1, S2, R1, R2, the classic pivot point formula, which we normally use it for Nifty trading. The same thing we can use it as far as dollar rupee also is concerned. As far as dollar rupee is concerned also, we can use the same pivot point formula. Now we will illustrate that also. We'll remove this. So pivot point formula. So we'll make it as 15 minutes. So today you can see the same pivot formula. Once it started cutting the PP, that is 79.51. It started cutting 79.51, and as soon as it started cutting 79.51, it started to move up, and then it went up to 79.61. 79.76 was the, of course, this is all happening right now because this market is not working in India right now. So we have got another market which is NDF market, and this is based on the NDF market thing. So right now we have 79. This is once it started to cut 79.51. What we could have done is that we could have put 79.51 with a stop loss at 79.35. Today it started to go up over 79.51, right? So once it started to go above the PP, we can put the S1 as a stop loss. We can put S1 as a stop loss, and whatever profit that we could get, we can get it. So this is a easy way of trading for in a daily chart. So the same classic pivot point formula, we can use it here. So what we have done is both for position trading and as well as for purpose of intraday trading, we have shown you. One, we showed the position trading very clearly. We can use just a trend line and use the trend line as a important support resistance points for trading stop loss. Now I'll tell you where it is. We'll again remove this. We look at the daily chart. So in the daily chart, now we have this particular low we can take, and this low we can take, right? So we'll look at the so this is the trend line that we have drawn, and you can see this trend line now likely to get support dollar rupee. If it falls, it's 79.31 right now. So as long as it does not come below 79.31, we can look towards being on the long side of the market. So it's very simple analysis, and you can be on any dip you can buy, keep 79.31 as a stop loss and do that. And also you can also look at the Fibonacci. Now we told you that this 61.8 or 58.6 is very important. So the last is 78.90 and this is 79.84. So that itself means something like 1 rupee 94, almost something like close to 1 rupee. So 1 rupee means some 23-25 paise from this level. So 79.10-11. So or 79.20. So somewhere around that particular place, you can keep that as also as a stop loss. You can keep Fibonacci levels also as a stop loss and trade. So you can use the same Fibonacci, you can use the same trend line concept to trade the market. So this is the very simple analysis that you can do, and based on this, you can look towards trading in dollar rupee as well as in other currencies. I'm not looking at other currencies for the time being because I want to go to the analysis of Nifty and Bank Nifty before I wind up. So we will look at other currency trading also, technical portion, and also dollar rupee again in coming weeks. Okay, so I hope I've given you a picture of the currency trading in terms of its characteristics last week, and also in terms of how to take positions and what type of stop losses, or does the base of what type of tools that we should use as far as position trading and intraday trading is concerned. For position trading, we are using the same 5, 10, 15, 5, 10, 20, 50 moving averages, and also we are using the same classic pivot point formula for intraday trading. That's all. Okay. So now we will look at the equity markets today. So look at the S&P. I think the data has come. So S&P is also looking for some sort of a fall there, but some sort of a support also coming there. So I think uh, just open and then slightly looking better now for time being. So we'll look at the Nifty contract right now. So Nifty futures right now, we'll go to the day chart. So this line this trend line is going to be the most important position, right? So if as long as it's not broken, you can be on the long side, but if it is going to be broken, then I think the entire issue is over as far as Nifty is concerned. So let's look at this. So tomorrow it's coming closer to the 15,800 levels. So 15,800 and then subsequently the rise from 15,800 will dictate whether the trend is going to be on this corrective upside or whether it is going to probably look towards a fall. So keep 15,800 as stop loss for any long positions that you will have in Nifty. Okay, so it can go up to 15,800 also, but revive from there. So closer to the 15,800 plus or minus some points should be the stop loss for any long positions. We will, if you look at it, the fall has been a little steep today, and the any rise now, first the resistance will come closer to the 16,025. Now the first rise, the resistance will come closer to the 16,025. Then probably the next resistance will come closer to the 16,115, because it hesitated for some time at 16,115, right? So the first resistance will come closer to 16,025, and second resistance will come closer to the 16,115. So mostly if it's going to go above 16,115, I think probably we are again looking at some sort of a upper move, which probably could target something more than 16,320, 330 levels, or even 400 levels if it is going to cross 16,115. The 16,115 keep as a stop loss for anybody who has gone short already in the market. Okay, and for any big long position trades, 15,800 should be the stop loss. And we have got support which is coming 15,930 levels. Now 15,930 is an important support level, and then 15,865 or so. So these are two important support levels which are coming closer right now, and let's see how it is going to work tomorrow. We'll look at the Bank Nifty also. So Bank Nifty has got deeper supports that can come as far as Bank Nifty is concerned, and this could probably the first support, if it falls, could come very closer even to 34,000. So closer to 34,000 is where we expect some support to come for Bank Nifty, and only a drop much below 34,000 probably will take Bank Nifty to much lower levels, back down to 32,000 or even down. So 34,000 is the place where we have to put in a lot of stop losses there. Similarly, those who are already short in the market, be careful if it starts again spiking above this place. There is this low, which is 35,000. So anything above 35,000, I think if you are already on the short position, you should look towards getting out of those positions, because this is the high which has been, that is one particular day's high has been broken, and so we should expect something like 34,965, 35,000 as a place where probably resistance can come. But if it is going to be broken, then probably we could be heading much higher, and it could take it back to the same high levels of today, which is 35,250, 260 levels. So but expect that probably, since there's a huge fall today, expect some sort of resistance closer to the 35,000, because today it has fallen at 34,825, 827. So the first resistance will come closer to 34,965. So a decent amount of correction which is possible, but Bank Nifty being Bank Nifty, it can just take above that plus particular level. So any rally about 34,965, you can be a buyer keeping this particular low or whatever low that has come till now as a stop loss. Now the first support now will emerge, of course, is the gap. So this gap is there, and this gap comes to 34,405, 406. So it will try to fill this gap, and once that gap is filled, then probably you'll have a fall which could be even a little more lower, and from there, if it falls further, then the overall trend of this Bank Nifty of the 32,000 to 35,000, probably we can expect to altered. So we can look at it that way. So most of the stocks are generally, if you look at the Bank Nifty generally has been doing well because of ICICI, one single particular stock has done very well. So, but the overall trend still, because this is the important high, and this has broken that 78.6. So the one advantage for this is it has broken this 78.6% retracement, right, or closer to that, right? So it has broken that. So that means Bank Nifty has a very decent possibility of getting support at any lower level. So because this rally has taken place and this has broken that 78.6%, so any fall in Bank Nifty, even if it cuts this trend line, we could probably keep on looking at some sort of a support to emerge for Bank Nifty at lower levels. So we have to keep a track. We cannot completely rule out the possibility of an important bottom, because 2-3 times, even if the Nifty has broken down, this has held, this particular position has held. So we have to wait and see how this is. So whether this is going to be a very important bottom, and any fall in Bank Nifty, whether it is going to go up, because it has broken the 78.5% retracement of this particular level. Okay, so that means we can be we need to be a little bit careful about it, but doesn't mean that it has already become bullish. So we have to wait and see how the Bank Nifty performs. But the first important support that is going to come is going to be closer to 34,000. If it breaks 34,000, you need to be very careful about Bank Nifty as well. So this is what it is. So you can put in your questions now. So hope we've explained the dollar rupee position very clearly. That is, the technical nature of the dollar rupee, the type of analysis that you do is the same whether you do in Nifty or whether you do in dollar rupee. Only thing, fundamental factors are different. So there are those things. As we understand a particular share company's performance, we need to understand the macro variables of why the dollar rupee is performing like this. When you have read that particular situation, you use the technical analysis for entry and exits, and the entry and exits come clearly with the help of moving averages or with simple trend lines, right? Okay, and intraday trading, you can use the classic pivot point formula. Yeah. Thank you very much, and so you can wait for your questions now. Nifty tomorrow's trend will be dictated by what's going to happen in global markets. Right now, most of the global markets are down by 1%, and whether there's going to be a follow through, we'll wait and see. If there is going to be further fall in S&P today, then in this case we will have a further fall in Nifty tomorrow. But having said that, let's look at the Nifty again from the support. See, this particular trend line, you can use it for support resistance place to know that. So it has come very closer to the so this is a important place where it is now there. Suppose if there is a reversal from this, is also possible, but if it is going to fall from here, then in that case we will look at this place. Which is the 15,825. So Nifty fall up to 15,830 cannot be ruled out tomorrow, but once it falls at 15,830, there can be a reversal, because it's very important, because there's a 20-day moving average also coming there. So 15,825, 830 is a very important level, and upside is going to be 16,100. Okay, so either it has to cut above that 16,100 levels or so, because today the high was 16,140 or so, right? So probably 16,110, 115 level, 16,115 level is going to be important. So please look at two important levels: 16,115 on the upside and 15,825, 830 on the downside. If it falls closer to 15,825, 830, probably you can buy, keeping 15,770, 780, 40, 50 points lower as a stop loss, and look towards a rally. And if it is coming closer to 16,110, 115 tomorrow, probably no, it can have some fall from there. So around 16,110, 115, you can look towards going short, but keep it some 25, 30 points above that as a stop loss. So thanks for your participation. So see you tomorrow with Nifty trend and weekly strategy tomorrow. Okay, thank you.